Hi, everyone. This is Jason Bjerk of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a first-time guest. She's considered a rising star of the hedge fund industry. She began her career at Goldman Sachs for nearly a decade, where she was an options trader. Also, she was head of the proprietary trading group for credit derivatives and over-the-counter derivatives trading. In 2013, she founded Quadratic Capital, and she's the managing partner and chief investment officer for Quadratic Capital for about a decade now, a little over a decade. And she's a portfolio manager for the Quadratic Interest Rate Volatility and Inflation Hedge Exchange Traded Fund, New York Stock Exchange ticker IVOL or I Volatility, and Quadratic Deflation Exchange Traded Fund, ticker BNDD. So inflation and deflation hedges here. Nancy Davis, thank you for joining me.
Thanks, Jason. Great to be with you today.
So Nancy, we're recording this interview on Tuesday, July 2nd, 2024. The VIX is at 12.06. The 10-year US Treasury yield, which is something I want to ask you a lot about with the bond market, is at 4.436%. The 10-year US Treasury yield, it's been a roller coaster for the last 6 to 9 months. I think 2.5 months ago, it was at 4.7%. Just about a week ago, it was at 4.2%. Are you surprised that we're having this type of bond market volatility right now?
Well, the bond market's been moving a lot. I mean, when we started 2024, the bond markets, if you look at Fed fund futures, was pricing in over six cuts from the Fed, and that's kind of been evaporated because the data, whether you believe it or not, is another argument. But the Bureau of Labor Statistics keeps publishing like really, really positive jobs data. And it's kind of been really moving a lot. So the spread between realized and implied vol has collapsed. So the way I describe that is realized is actual prices and implied is what's priced into the market.
So that's constantly changing that spread. And you're saying that that's what the expectations are, what's changing the US Treasury yield so much?
It's just the interest rate vol, FX vol, equity vol, kind of all volatilities tend to be correlated with each other. I think maybe since I love the title of your podcast, I think maybe just to quickly break it down, I can explain in layman's terms, if you don't mind. Forgive me if this is too basic, but I feel like volatility, a lot of people don't necessarily understand. Like any market that has an options market has a volatility market because volatility goes into pricing options. So it's sort of like, do you wipe your nose with a Kleenex or do you use a tissue? When you talk about volatility markets, you're talking about options markets, which are a subsection in the derivatives world. Most derivatives are, what I would call linear derivatives, like futures, forwards, swaps. They go up a dollar, they go down a dollar. Sometimes they're called delta one. The thing that I focus on is the less than one delta, which is the options market. So that's things that have a asymmetric payoff. Is that helpful? Just to explain kind of like when you're talking vol, you're talking options.
Okay, so the volatility is not going to change exactly proportionate then to the amount of move in the US Treasury market or the stock market then. That's, I think, the point you're making, that's not going to be linear.
Well, the point that I'm making is that there are a lot of different types of volatility markets, and one volatility market is, the S&P market, which is really popularized because you can easily see it through the VIX, which is 30-day S&P options. The interest rate markets are a little bit harder to kind of see. And see what's going on, but you can look at the daily move in basis points to see kind of what's realized vol is. So how much, whether you want to look at the 10-year treasury or the 2-year treasury or even, 30-year, you can look at different points and look at their realized vol with the daily price move. And then you can look at where implied volatility is, which is the price of the options market. And there are obviously a lot of different levels of implied volatility because you can have, a 1 month option or a 1 year option or a 5-year option. There are a lot of different tenors. So typically in the in the bond markets and fixed income markets, options tend to be priced a lot longer dated. A lot of that comes from the structured products market. But yeah, there are options at all different points along the curve in the rates market.
Now, you focus mostly on institutional investors and hedge fund trading. The retail investor, this sounds very complicated. It sounds like the retail investor, if they don't know what they're doing, they're going to lose a lot of money very quickly trying to trade these types of options.
Uh, a lot of individual investors can't even access this market because it is the rates market, like the mortgage market, for instance. Just to take a big step back, now mortgages are in kind of every mom and pop retirement account all around the country. If you look at probably, your mom or your dad's 401k, they probably have, typically about 25% of their bond portfolios allocated to mortgages. And mortgages are really complicated because if you own a mortgage, you're actually short options to homeowners. So I'd say there's a lot of complex products out there on the fixed income side that are, used in bond portfolios that are definitely more complicated than equities. So I think there's a lot of complexity. And I don't think, people talk about prepayment risk or even what happened with Silicon Valley Bank. I just don't think a lot of people actually understand that their bond portfolios are short fixed income vol for the most part.
That's
So yes,
interesting. Do you think that there a developing supply demand problem in the US Treasury market is that going to increase volatility with the yield spike and then the corresponding options on the different bond yields at the different duration?
it's the volatility markets are definitely driven by supply and demand, and a lot of it is also linked to credit because there's a lot of investors will because credit spreads are so incredibly tight, there's not a lot of yield above government bonds, so people will tend to sell volatility as kind of these carry strategies, which are typically wrapped inside of quantitative strategies that systematically sell options. And I think that's one of the reasons, like if you just close your eyes and you're like, all right, 2024, we've had major moves in expectations for, we went from more than six cuts to, barely two in about a 6 month period, since it's right ahead of July 4th, approximately, call it 7 months. But you would expect, would volatility be higher or lower? And vol is down about 30% across the board. And that's pretty surprising given all the fundamental issues out there, with whether it's the Treasury refinancing the debt or the fiscal situation or even the election. So it's been crushed across all asset classes this year.
Well, that's interesting that the bond market volatility is down so much considering the roller coaster of the actual yields on the 10-year US Treasury. But to your point there, the VIX, which is the stock market volatility, I mean, that thing looks dead at 12.06. It has not moved at all.
Yeah, and that's the spread between the daily moves, which is realized vol, versus implied, which is what's priced into the future, is really collapsing in the fixed income markets because the markets have been moving a lot, but typically implied volatility trades above realized volatility, but it's actually flipped where implied vol in many instances is actually trading below realized volatility, which is even more bizarre. And that's taking place in the fixed income markets.
So this leverage short volatility that you talked about briefly, Christopher Cole of Artemis Vol, and that fund, I think it's closed down in the last 2 years. I think a lot of pension funds and institutional investors pulled their money out a little ahead of time. I think they went into commercial real estate and doubled down on private equity and other stuff. Is that what's tamping down volatility? So there's a lot of people out there, institutional investors, pension funds looking for income. So they created this synthetic leverage short vol trade to sell volatility to make it into an income product, and that reduces the amount of actual volatility in the stock market.
Yeah, there's definitely a lot of vol selling that's taking place across the market. It's in the equity market, it's in fixed income market, and a lot of the strategies are being sold as systematic strategies with enhanced carry. So it's sort of like making a movie and saying, oh, it's G rated, but it's not really G rated because, carry sounds like a really benign word. Short volatility does not sound as benign, but these carry strategies are embedded systematic short volatility strategies.
Okay, so this carry, how does the carry get in trouble? Is it like 2018 or 2019 with Volmageddon, or is it like a move in currencies or interest rates of the bond market? How would like these strategies get into trouble?
There are a couple ways they can get into trouble. Number one is, it's not with Volmageddon, that was really more of, I'd say, the couple things going on. It was the C card change with regulation at the same time that retail investors have built up a very big short. These hands are more, I'd say it's more institutional at this point. So it's more on the institutional side, which is, potentially has deeper pockets. So it's hard to know if you're going to have, a Volmageddon kind of thing. But I do think it just makes the price of owning, owning volatility as a long in your portfolio, owning it as an asset class is really cheap. You could say, oh, it might go down more, but it's one of the few things that really tends to be negatively correlated to, when other things in the portfolio are losing money. So I think it's a good time. It's hard to know, like with a crystal ball, what's going to change it, right? It could be a liquidity problem. It could be, maybe we have a stagflationary environment. Maybe the Fed reduces their balance sheet more. There could be a lot of reasons, but it seems like it's definitely kind of low to buy options generally in portfolios.
So your exchange traded fund, have you back tested it like with commodities and gold to where if someone has it in a diversified portfolio with stocks, bonds, other things, to where that will smooth out some of the returns or provide diversification?
We can look at correlations. I think that's it's an actively managed fund, so it's not an index fund. There is no actual index for the market that we're accessing, which is in the rates market. And so you're not legally allowed to do back testing, but the fund is more than 5 years old. So you can look at the history and also look at correlations to kind of other asset classes. And I think it is different, right? It's not what people traditionally own in their portfolio because it, depending on which
Is
fund
it
you're looking at.
is it like a tail risk insurance or black swan insurance you would say for the inflation and deflation hedges then?
No, no, I would say they're more just treasury funds. They're not, you know, they're not tail hedges per se. Like both funds are long volatility, right? Any place, like we talked about earlier at the beginning, any place you have the ag or, core fixed income, you're probably, 25% typically, which is the benchmark, is short fixed income volatility because homeowners are long the option to prepay. If you own the mortgage, you're short options to homeowners. And so for us, it's just giving people choices to say, look, we don't want to only be short volatility in our bond portfolio. And instead of using leverage, which is what a lot of strategies do in fixed income, is they use linear derivatives to kind of they get more exposure than what they pay for. Ours is a long only strategy that uses that positive convexity that you get from owning options. So what that means is, the amount you can spend, to buy an option, that's a most amount that you can lose, right? You can lose 100%. It's not saying you can't lose money, but you always know what you can lose. And then when the strategy works for you, you have a potential asymmetric payoff, meaning you can make more than what you've spent. It's that positive convexity. And
And
so
for
people use it as a, instead of just owning treasuries or inflation protected treasuries on their own, they use these strategies as a complement.
Okay, now I'm going to ask you for our listeners out there, because not everyone is worked in a bank and also a hedge fund manager like yourself. What is convexity and what is dispersion?
Okay, so convexity is a term that people throw around a lot in the bond market. There you can be long or short anything, just like you can be long or short volatility, you can be long convexity or you can be short convexity. Sometimes it's called negative convexity. And a similar term in the equity market is gamma, right? You hear that all the time. Oh, dealers are long gamma, short gamma. That's kind of the jargon term in the equity market for that. It's basically how quickly the delta of an option changes, right? So, very simple example: if you take a at the money option, its delta would be zero point 0.5, meaning it wouldn't. Whereas, if say it's a whatever asset class it is, a future forward, that would be a one delta product. So this would be half, and it's how quickly that delta picks up or falls. And as you get closer to expiration, your, the gamma increases, so it can change more quickly. Extreme example would be, say you had an option that expires, tomorrow morning, right? It's either going to be, and say whatever it's on is close to the strike, right? So it's either going to be in the money or out of the money. It's either a zero delta or a one delta. So that's kind of the extreme example, but it's how quickly that delta of the option changes. And bonds have convexity. And then most people, to get their bond exposure, will use leverage, right? They'll use, futures or forwards, or they don't fully fund their bond portfolio. So that convexity is when your risk is not symmetric, right? So if you're long convexity, you can gain more than you can lose. And that's what we focus on at Quadratic. If you're short convexity, which is any place you're selling volatility, selling options, it's asymmetric to the downside, meaning like say you sell an option, you get paid, I don't know, $1, but let's just take a simple example. If you sell a call option naked, in theory, that thing could be, you could sell it on, I don't know, NVIDIA, right? There's no cap. You can have asymmetric losses if it's not a cap strategy.
So, since you've traded stock options for a long time and credit and derivatives for a very long time, I want to ask you about the effect of the size of the options market, derivatives, on the general underlying assets. Do you think that it's increased volatility as options trading has become popular among retail investors now with the Robinhood app and other stuff?
I think there's a lot of ways that investors have more choices. So there's a lot more transparency out there in the market. There is a lot more trading too in, markets that are in the equity space. I'd say there's not as much trading that I'm seeing in the fixed income markets. It's more kind of one way. Um, but yeah, I don't know much about the Robinhood app because I've never used it, so I can't comment on that.
Oh, well, I was just talking about in general, like total volumes, how you have tons of retail traders, and I don't think they know very much about the stock market. Maybe they're just looking at charts, so they're trying to get extra leverage by trading stock options. And they're not borrowing on margin. They're using like leverage ETFs and stock options instead. Or now, what, 0 day options, which is kind of ridiculous.
Yeah, there's a lot of froth out there in the market, and I think sadly, like there is a lot of, even things like short duration bond funds. I don't think a lot of people understand, the structured credit exposure inside, you know, if it has a short duration bond fund that doesn't take just treasury risk, it tends to have a lot of credit spread risk or a lot of structured credit. And I don't think people even understand that. So I think, the focus recently has been kind of on these 0-day options and kind of all the speculation and trading. But there's a lot of things that I think people don't necessarily understand, like even basic things. Like I don't think most people even understand how a mortgage works. When they own a mortgage in their portfolio, which most people do because it's in the index. So it's tough. I mean, that's why podcasts like yours are helpful because you can try to, there is a lot of jargon. I joined Twitter, pretty recently, and I spent like a weekend just defining jargon, like literally just like, you know, writing out words and being like, this is what it means in English. Because there's so much noise and people throw around these terms without really explaining them. So,
These 0-day options, it looks like the institutional investors and the market makers created these things as an income product to sell more volatility and then get retail to trade more of these things. But then it's like an income product for institutional investors, similar to the leverage short vol trade, another income product that's risky with like a defined amount of money that they can make, but the risk is way higher than the institutional investor thinks by selling volatility.
yeah, definitely. I would agree with that.
So, in terms of the Fed keeping interest rates higher, stagflation risk, you talked about the basically selling volatility in the bond market. If there is prolonged stagflation, if the Fed does not cut interest rates, do you think a lot of these market makers, institutional investors that sold volatility in the bond market, are they going to be in trouble 6, 12, 18 months from now?
Yeah, I mean, I think stagflation is sort of the nightmare scenario for everybody, right? That's it's actually like a term they made up um, because they didn't really know how to explain, higher prices but lower growth, right? And I think especially because Powell, I don't think it was the last press conference, but the one before that, he was actually making fun of stagflation. Remember, he was saying, like, I don't see the stag and I don't see the inflation. He made some joke about it at one of the press conferences in his live Q&A. And I feel like that's, almost manifesting that it's going to happen because it really is a disaster because generally people think, stocks and bonds are negatively correlated, meaning when their stock portfolio sells off, their bond portfolio goes up. And that's not guaranteed to be the case. In a stagflationary environment, it's more like 2022 when kind of everything goes down together and stocks and bonds actually become positively correlated. And that sort of breaks that traditional 60-40 portfolio.
Yeah, I was going to bring up the 60-40 modern portfolio theory, and then you add in the leveraged bond trades like the basis trade and risk parity. And so a lot of these large corporations, they added on enormous amounts of debt on their balance sheet. Not all of them refinanced close to 0% interest rates in 2020 and 2021. So these higher rates staying higher for longer, I mean, they're going to cause a lot of problems in the real economy to small businesses and Main Street and the consumer eventually.
Yeah, absolutely. And I think, small businesses are really hurting. There's a lot of inflation and kind of day-to-day, people's lives. Like I run, my firm, is a business, and even things like our healthcare costs, it's going down in the CPI because of the way the Bureau of Labor Statistics changed the calculation. But like our healthcare costs continue to go up as a business. They have gone up double digits ever since the pandemic, and that doesn't seem like it's changing anytime soon.
Oh yeah, I agree. I call it stagflate tax lie. I don't think the CPI accurately accounts for rent either. Owner's equivalent rent seems fake too, especially with people's mortgages, the monthly mortgages at these interest rates.
100% agree, Jason. And that's, I think part of the reason why we created, why Quadratic started the iVol ETF was TIPS, which are treasury bonds, right? They're US Treasury, but they're adjusted for inflation. And the only index to adjust for inflation is the consumer price index. It's the only index that's used to reset TIPS. And, I remember I started my career at Goldman right when the US Treasury started issuing these bonds, and they're pretty new, like relatively speaking. They didn't exist in the 70s and 80s. So a lot of people will look back and be like, oh, what worked in the 70s and 80s? Like the inflation markets didn't even exist then. There wasn't such a thing. So there's nothing to look at. But I think one of the big problems with inflation protected bonds is that it only uses the consumer price index. It's like nobody in the equity world would ever use, the Dow Jones or the Russell or the NASDAQ. Like even the Fed doesn't use the consumer price index because a third of it is rent, and it's that shelter component for owner occupied rent, which is just, it's silly to only use one index to capture something as big as inflation.
Well, for rent, I mean Zillow, National Realtors Association, Redfin, all those data sets are way more accurate than the PhD economists making up owners equivalent rent. But the
Yeah.
but
Yeah.
for tips though, does the Federal Reserve Bank, do they own 20% of all the tips, Treasury inflation protected securities?
You can see what the Fed owns on their Soma holdings. I haven't looked like in the last at tips specifically, but there's a link in my Twitter feed, or I can send it to you to link afterwards. So you can actually see. I think the big thing that freaks me about is they own, about $4 trillion of mortgages. And they've said publicly that they don't want to own mortgages on the balance sheet long term. And because interest rates are higher, people are not prepaying their loan as quickly. So the duration is extending. And I'm sort of like, that's kind of tricky, especially because pretty much every single 401k and pension fund, because the index is market cap weighted, which don't even get me started how stupid that is for a bond fund. But 25% of the index is mortgages. There's a lot of issues out there.
So not the Bank of Japan levels yet, where I think at one point they owned 70% of all the index funds for stocks, and they were buying up a ton of the Japanese government bonds.
Yeah, we're not there yet, but Japan's been a big owner of treasuries, and even that thing that happened a couple weeks ago with the CLO whale, they came out and said, "Oh, they're going to sell treasuries." And then all of a sudden they have a reverse repo line at the Fed. Like, really? Yeah, it's can't make this stuff up.
Oh, really? I haven't seen that covered anywhere. That's really interesting. And the other thing that people aren't covering that much is, and you sent me an article on this recently, is the US Treasury repurchase program. That's the first time that's started since the 1990s, right?
Yeah, and nobody's talking about that either. I mean, it's bizarre, right?
So this Treasury bond repurchase program, is the Treasury, the Fed is giving them more currency and the Treasury is just buying the bonds and retiring them? What is going on here? Because it doesn't sound like the Treasury, I mean, what, they took a bunch of money in reverse repo. Say they've been doing that to kind of keep liquidity in the stock market and the real economy. But where are they getting the funds to buy the bonds?
Yeah, it's the printing machine.
Oh, so you would call that then some type of debt monetization or quantitative easing then?
Yeah, that's part of the reason we created the debt machine deflation fund. It's on, we literally have a slide about the debt machine on our if you go to bnddetf.com, you can see the gears of the machine. No, it's definitely, there's a lot of funny. I mean, look, people will own treasuries and people will own inflation protected treasuries at the same time, right? You don't have to have one or the other. They kind of sound like they're opposite, but it's not. They're both risks to investors, and it's just really unclear which way things are going to go. Like right now, the markets in rates are definitely priced for, kind of this disinflation and the Fed cutting rates and inflation not being a problem. In my opinion, because most bond investors don't own any inflation protected bonds in their portfolio. And then I think tips are not great on their own. They're only CPI and they're all long duration. Um, I think IVOL is a nice thing for people to potentially look at or talk to their financial advisor to see if it's appropriate to add inflation expectations outside of CPI. It's definitely tricky because the yield curve is so incredibly inverted. It hasn't been this inverted for this long, in our lifetime. So it's tricky to see what the future is going to be. And really, I think the market's kind of giving you, there are very few things that you can buy today that are trading at valuation levels below the 80s. And the yield curve is one of those few things.
And we've had an inverted yield curve, I think, for 2 full years now, the 2 and the 10 at least. So it's 2 full years, I think July 2022. So 2 full years there. And then we don't have an official recession, but I would argue that Main Street, a lot of the real economy, small businesses, the consumer, the real economy is bifurcated. A lot of the consumers are tapped out. But because the US federal government is what spending, I think they're projected to spend around $8 trillion for fiscal 2025, that's keeping the official recession at bay for now.
Yeah. Yeah. It's Ival accesses the twos tens yield curve inside the fund. It uses fully funded options to do that, but it seeks to benefit from the uninversion of the yield curve, or upward sloping curve, which is more normal. Like, even you're talking about Japan. If you look at the Japan JGBs, or even the twos tens JPY swap curve, today, July 2nd, it's positive 65 basis points. So upward sloping, and I would say more normal. Whereas if you look at our twos tens SOFR curve, today the spot curve is negative 59. So it's like literally opposite signal, and negative, not positive, and lower than even where Japan's upward sloping curve is. And so it's kind of nonsensical what's going on in the market.
Sounds like a long-term bond bear market to me.
Well, I think that's one of the things I like so much about iVol is you don't necessarily have to take a bet about where interest rates are going to go. It's more of a spread trade. It's more about like having, the yield curve uninvert, real yields, which have not been this high in, a decade plus, go down. And most people don't own inflation in their bond portfolio because it's not part of the index. It's not in the ag. There's no tips or any kind of inflation protected bonds within the ag index, which is what most people use for core fixed income and institutional portfolios like 401ks.
And I don't think they own gold or commodities either as inflation or deflation hedges for further diversification as well as that too, because I think I saw a chart that was showing that institutional ownership of commodities and gold is 1% tops for assets under management.
I don't know those stats, but I think a lot of people will look at what happened in the 70s and 80s, and they look to, like, oil had a very specific thing with the embargo. And gold has a lot of, what, like, I own gold. I'm not like anti-gold, but I don't think it's the best inflation hedge in my opinion, because especially when you have policy rates, you can buy a 1 month T-bill and get paid, 530, right? Gold just doesn't have any kind of monthly income. And so I think it's great for psychology, or for the safe haven, or the perception, but I personally don't think it's a great inflation hedge. And I think people look at it because, going back to the 70s and 80s, the inflation protected bond markets did not exist, right? There was no rate derivatives market. The Treasury only started the inflation protected bond markets in the US in the late 90s. So going back to 70s and 80s, you don't really have anything else to look at besides equities, real estate, and commodity markets.
So let's say the Fed does panic at some point. Let's say a large bank breaks. This is hypothetical. Large bank breaks larger than this Japanese one in the last couple of weeks, and we go from inflation to deflation very quickly, and maybe back to inflation again, all in like a couple months. Will that cause a lot of problems for this selling convexity, this leveraged sellers of volatility in the bond market? Then we going to see a lot of problems with whichever a bank or institutional investor or pension fund sold a lot of this volatility then?
It's hard to know because it really depends on, the amount of leverage out there, the funding needs, the amount of liquidity in markets. Like I definitely worry a lot about liquidity. But I think, every single time there's been a, kind of disaster in markets, it's really comes back to mortgages. If you look at like the savings and loan crisis, the mortgage market had not yet been QSIPed. It was all over the counter. Then it became QSIPed, and now it's in all of these, mom and pop positions because it's in the index. 25% of the index is mortgages. Even the financial crisis and that mortgage exposure, and that's kind of what I try to stand on my pedestal and explain to people that if you own mortgages in your bond portfolio, you generally are short fixed income volatility. It's not the VIX, it's not equity vol, it's fixed income vol because homeowners are long the option to prepay and you're short the option. And whenever you're short options, you're short vol. And so that's why we created these funds at Quadratic. Both of them are long interest rate volatility. They both own options. They're long only strategies that buy treasuries and fully funded options. And it gives investors choices in their bond portfolio to not just be sitting there only short fixed income vol.
Are you seeing a lot of people paying their mortgages, prepaying them right now? Because this
No.
environment with like higher mortgages and people's discretionary income, their savings being depleted, I don't really see that as an option right now.
Yeah, no, definitely not. And that's what the reason I mentioned this is because you talked about banks blowing up. If you go back and read the 10Q from Silicon Valley Bank, you read in their footnotes the reason their duration extended so much and they lost, they had basically people who came and said, okay, we want our deposits back. And then they had to go unwind their balance sheet. Their balance sheet was underwater because they mismodeled the prepayment risk, and homeowners are rational, right? If interest rates go up, of course people are not going to prepay as quickly as what was modeled. And because the Fed hiked rates 525 basis points in about a 12-month period, which nobody was talking about, right? Nobody thought they were going to hike that much that quickly. Of course the duration extended, and that's part of the reason, or a big reason, that there was that problem at Silicon Valley Bank. And all those things are still going on, right? There's nothing different other than markets are not worried about it
Yeah,
right now.
I see a lot of problems with the banks. I mean, I see like commercial real estate. They have losses on older bonds. They have losses on what the variable interest rate debt for auto loans, consumer loans, small business loans. So it's not just the mortgage risk or prepayment risk that you said. I mean, I see a lot of risk now for the banks.
Yeah, there's definitely been a lot of regulation, but there's also it's a global market, and there's a lot of risk to other banks outside the US too, like the Japanese banks, the European banks, like all the same problems still exist, even though there's more regulation.
Well, they got into derivatives, right? This Japanese bank, the fifth largest one, I can't remember its exact name, but they're one of the market makers for the collateralized loan obligations. So that's not mortgages. That's that's worse than junk bond debt.
So those, I wouldn't say they're derivatives, right? So derivatives definitely have a bad reputation for a good reason, right? And there are lots of different types of derivatives, but generally, most people invest in linear derivatives, which is basically, I think of it as almost like a credit card exposure where you put up a little bit of money and you get exposure to a lot more than you paid for, right? What we do at Quadratic is fully funded, long only interest rate options. So there's never an obligation on the fund to pay more than what we paid for the option. It's long only. But CLOs are, basically levered loans inside of with leverage, right? So it's not non-linear products, it's linear products that are just using leverage. And then they tranche it out. It's very, you know, and a lot of people have been running into that asset class because they want floating rate. Um, but now that we're kind of entering potentially a new regime with the Fed cutting rates, that's also a risk. And so there's a lot of leverage out there in markets, especially in fixed income markets.
Okay, so collateralized loan obligations are not the derivatives that people think of, but they sound similar to kind of the riskier mortgage-backed securities, but they're what business loans, so they're kind of structured similar to junk bonds, but the collateral is not even as good as junk bonds for some of them.
They're credit products. So it's sort of it's a credit, you're giving a company a loan and then you're putting it into a structured vehicle that uses leverage. So it's levered loans with leverage. Um,
Wow,
would be,
wow,
but it's not derivatives. I mean that it's using leverage to borrow money. So it might be using derivatives to get funding, but it's not a derivative product per se. But my point is that derivative products have their own bundle of problems, right? It's not, I'm not saying that it's good or bad. I'm just trying to distinguish it. It's a credit product. And it's been really, really popular in Asia for that yield enhancement.
Yeah, interesting. So you just explained the difference between your exchange traded funds and these leverage products here, and those do not have even the collateral of junk bonds, and junk bonds have questionable collateral.
Yeah, everything has gone what they call covenant light. Some of them have no covenants at all. So there haven't really, if you look back over history, levered loans haven't really had defaults. But the issue is that the lending standards, because so much money has been coming into the asset class, everything has gotten more and more covenant light and more competitive as more money has flown in. And so I think that makes it questionable whether it is this, kind of, hey, no defaults in these other cycles, whether we're going to see that in the future because the lending standards have been, reduced.
And we know that there's going to be problems at some point because we saw that Wall Street did this with mortgage-backed securities. What stuff that was stamped as AAA was not really AAA with the ratings agency. So I would suspect that at some point there's going to be problems with these things.
Yeah, and there's also like a huge, kind of other market, which is private credit, right? A lot of people are saying, "Oh, private credit, it's so, you know, it's like magic unicorn, non-correlated, and they're not all bad strategies. I'm not trying to generalize, but I think, at the end of the day, when you're lending money to corporates, whether it's loans or, private loans, it's still corporate risk. And that has a very similar beta, to stocks, right? Because stocks are the it's a different part of the capital structure, but it's still corporates. So if you have a portfolio that has a bunch of, CLOs and bonds with credit risk and then a bunch of stocks, you kind of have, a one way, like it's all corporate risk, right? So if we have, that bad word stagflation, or if we have recession, corporates can have, like simple example, if you own, Microsoft stock and Microsoft bonds, and they have a problem with their, whatever. I'm not picking on that company. I'm just trying to use a general example of corporate exposure. It's sort of the same beta. And so that just goes back to saying, look, it's really important to be diversified and to be thinking about, where assets are priced and looking for things that, can help diversify your savings, right? The whole point of portfolio construction is really to not have everything lose money together when you are, especially if you're not working. And that's why I think investors really should be worried about having exposure to inflation, because whether it's going up or down in the future, if you're not in the labor market, right? If you're retired, you're just going to have a higher cost of living, a higher, higher expenses because you're not going to be benefiting from any kind of wage inflation.
And it's perplexing why these university endowments like Harvard and others, why they got involved in a lot of these income products, like the private credit pools and stuff like that. And there's rumors that like they're not getting paid on a lot of this stuff for some of the corporate debt when they could be just buying short-term T-bills, like you said earlier in the interview, for quote unquote risk-free, over 5% yield.
Yeah, it's not as sexy, right? To have treasuries, but But I think, it's a new era too with I think looking at, these complex strategies, maybe a while ago there used to be a, kind of liquidity and complexity premium, but so much money has flown into them. I think you have to look at, the overnight, 5.25 is, you could argue whether treasuries are risk free or not, but that's kind of the bogey for all these other strategies. And I think there is a lot of money kind of chasing performance of the past and looking for diversification, but it's sometimes a name only. It's not real.
Well, also the fund manager can't justify the high fees and commissions that they're charging if they're just going to tell their clients to park it a lot of their assets into what short-term T-bills or gold or cash right now. You're not going to earn the management fees. The clients are going to say you're fired.
Yeah, I'm not a financial advisor, so but I could imagine that that could be a issue. It would be pretty boring, right? But sometimes boring and simple strategies are not necessarily a bad thing, right? I think sometimes people try to make things overly complicated.
Well, Warren Buffett said most of his investment strategies is using seventh grade math, so he's produced pretty good returns over his career.
Quadratic is named after seventh grade math, so I've never thought about it that way, but it's named after you know, the quadratic equation. So
Oh, okay. Now I get it now. But you're a quant though, right? So you're an old school you're what people would call a quant, right? A quant hedge fund manager.
no, I think the quadratic equation is just an algebraic equation, which, graphically is like looks like convexity. So no, we're not we're quadratic, not it's QUA, but not quant. It's just the same first three letters. I don't think of us as a quant strategy.
Well, I really enjoyed our discussion today. It sounds like you have a nice exchange traded fund hedges in place for our listeners out there to do some more research on, along with gold and whatever else is in a diversified portfolio. But unfortunately, I think with the policies that we have with all these governments and central banks, I think we're going to have a lot more volatility going forward. It looks like we could have a lot more liquidity from governments and central banks and potentially a bond bear market that the government's going to cause.
Well, thanks for having me on. It was great to discuss these things, and we're all about education. I try my best to not, to help people understand what's out there and just educate.
Well, in the mainstream, they don't really talk about volatility, and most of the time, what it's 60/40 modern portfolio theory just with stocks and bonds.
Yeah, no, for sure. And volatility, I think, has this like negative connotation because people think of it as like losing money. And I just want to explain to people that you can be long volatility or you can be short volatility. The problem is most people in their bond portfolio are just short volatility.
Well, in the stock market, volatility is normally a good thing. Could mean a buying opportunity, could mean discounted good stocks that go on sale. So it just depends on the asset class, I guess.
Yeah, 100%. So, well, thanks for having me on as your guest. It's really a pleasure. And yeah, let me know, if you had any questions. People can find us on our on ivoletf.com, our website, if they have any questions about anything we talked about today.